When you go to bed each night, imagine that you'll have more than $50,000 in your bank account at the end of the month, no matter how much you work or how little time you spend. Peter Thornhill is an Australian investor who makes almost $500,000 a year from his investments. What a life, right? Peter is a popular financial expert in both the UK and Australia because he has written a book called Motivated Money and had given many motivational speeches. It's common for Peter and his dividend growth focused investment strategy to be talked about on websites, in lectures, and in discussion groups. In this video, we will go through the 6 dividend investing strategies by Peter Thornhill. I'm sure you'll definitely like this episode, so before we start with the first one, make sure you click the like button and comment below with your thoughts about the topic. Number 1. Choose the best stocks to invest in. Peter buys funds from different companies so that he can own profitable businesses that give some of their profits to their shareholders in the form of dividends. Some of the most common types of investments for people are low-cost, diversified index funds, or ETFs. In Peter's opinion, the best investment firms have been around for a long time and consistently raise their dividends. Number 2. Invest in stocks that pay dividends to build a varied portfolio. To make money, you should buy stock in companies. People need to know that the stock market serves 2 important roles. Firstly, it allows businesses to get money, and secondly, it gives investors a good way to trade their shares in these businesses. The uncertainty of the market on a daily basis causes a lot of confusion and misinformation, but the market's liquidity often causes it to fail. According to Peter, we should not waste our time on this. It's possible that our net worth and ability to save for the future will rise as long as the stock market keeps going up. What is the point of dividends? A person who makes a lot of money could choose to give some of that money to the people who own the company. If we make money, this is called a dividend. If the company makes money, it will also keep some of it to invest in the company's growth, like making new products, expanding the factory and machinery, or spending the money on research and development. In the long run, more future income and profits show up in dividends and stock prices. Number 3. Use your dividends to acquire more stock. It all depends on how many shares you own. Every 2 years, you'll get back money from the company. There are many ways you could spend this money, but the best thing to do is to buy more shares in the company, which will make you get more dividends down the road. Keep adding to your stock portfolio until your dividend income exceeds your expenses. As you save and reinvest dividends, that compound interest increase will grow over time because you keep doing this. It may take a while, but in the end, you will have enough money coming in to pay for all of your own needs. Most importantly, your savings, how much you put in and how much you spend. The long-term rise and fall of the stock market has always been there, even though there have been some dips in the market. Do you know the S&P 500? The S&P 500 is an index that monitors 500 publicly traded firms in the United States. Take a look at this list and you could start investing there. Moreover, it is important to keep some cash on hand if the markets don't do as well as you expect. There are times when the stock market doesn't do well, and people who have saved a lot of money will be forced to cut back on their spending. Relying only on the stock market's predictable revenue stream would be easier in an unstable market. It's best to keep track of your portfolio no matter what else is going on. You can use your cash and spending power to fill in for your expenses when dividends fall because of lower company profits during market uncertainty. You can do this easily for many years until dividends steadily rise again. Because of their capacity to maintain a cash reserve, listed investment companies' payouts are more stable than others in the market. This is likely a good source of reassurance throughout any declines in the market. Number 4. Don't get trapped in overpromising yields. Investors tend to overestimate how much money an asset will make in the short term. People in their 50s and 60s like fixed income and term deposits like traditional income investments. If we want to get the most out of an asset's income, we need to think outside the box when we invest. An investment in Australian stocks has always made more money than an investment in a term deposit over the last 37 years. In the beginning, term deposits pay out more money. Terms made $274,225 over the course of 40 years, with the final income payment totaling $1,250,000. Shares made $1,076,489, with the final income payment totaling $83,633. In the end, the fixed deposits were worth $100,000, while the shares were worth $2.5 million, a $100,000 difference. People who work in the financial sector call term deposits income investments because they make a lot of financial sector. There is a lot more money in shares than in term deposits, even though they are often thought of as growth assets with lower returns and a highly unpredictable share price. Number 5, don't take on more debt than you can handle. It's common for people to get a loan to buy their first home. Then they borrow more money for furniture and a car and so on. On the other hand, Peter says that you should think about buying or renting a cheap house so that you can keep working on your stock portfolio. Lastly, at number 6, don't spend more than your income. This is self-explanatory. The rate at which you save money is critical for amassing financial security. To sum it all up, Peter's method is all about making money while disregarding the stock market's fluctuations. A large part of his investment approach is to acquire a mixed dividend-paying stock portfolio and keep it for the long term. As what the new generation would say, HODL. Thank you for being all ears throughout the entire video. If you'd like to learn more about the nature of this business,